So obviously, thank you guys for coming on another Tuesday call. You guys know the spiel, but real quick, I just want to hit this topic real quick because we were kind of bouncing ideas before, and then I'll go through the slideshow. But a property we offered on that we were told someone came in, no contingencies, all cash, out of country. We had no chance, but we were the highest bidders and before that. Like we were ready to like book our flights and make our way into town and like start walking the property. And then we lost the bid, which happens. It's not a bad thing. I recently need someone else because they know my buy box, they know I like Florida, they know I like this part of the country in regards to buying multifamily. It's like, hey, I know you like this stuff. And they sent me in. And I was like, why do I know that building? Obviously, I remembered pretty quickly that that was the one we'd offered on. So I called the broker. I'm like, hey, emergency phone call. Call the agent for this property right away. He calls them. He's like, holy crap, they're back on market. So when we thought there was no way we were getting that was going to come back on market, now we're like, okay, like we have the underwriting ready. We updated some of the docs because it's we got new information from them, so we updated some of our numbers, and we're probably going to submit another LOI. So it's you never know where that next one's going to come from, and I think that's a pretty good way where if you do put an offer on a property, and I think this is important when we say on the underwriting sheet to keep each sheet with its own address and like save it and like label all of them and make sure you don't get rid of that stuff, because when these opportunities come up again, like for lack of a better way to put it, shit happens. There's a lot of reasons why you can have an escrow fall out, regardless of what the agreement was getting into escrow. So keep in mind that like keep that stuff ready, even if anything, go through your old underwriting and be like, hey, what happened to this property? Did they end up selling it? Did they end up getting a contract that end up closing XYZ? Then you do all that, all of a sudden you may still have a deal potentially there where if something were to happen, and you never know, anything can happen at any time. Uptick in those opportunities for funding falling through. This one wasn't a funding because I think they're funding it themselves anyway. Like, there wasn't a loan issue. My broker told me, and I can't remember why they got back, like why it became available again. I think it was something regarding not like an inspection that's a massive like red flag for us, but it was just something I think in regards to like how their money was being transferred or something like that, like a legality kind of thing. But I am seeing, and sellers and brokers are definitely going to have this red flag of, can you raise the funds? And that's always going to be the question. At the end of the day, I kind of like hit this point a lot yesterday. Your brokers are always going to look for the people who are going to be able to close the deal, and that's just the bottom line. They don't care if you have the highest offer. They don't care if you have the best terms. If you can't even close or show a track record that you've closed, none of that matters. Especially in this world of wholesaling and kind of the whole, I guess not even in multifamily, real estate in general, where people are like, oh, go just get on the contract and figure it out. Brokers don't like that. That's not fun. So you guys know who we are real quick. I'm just gonna go through this. My name's Edward, based out of Los Angeles, California. Been in real estate for a while now. Gone to the multifamily space pretty. I wish I got into it sooner, but I also am kind of happy, like, and better late than never, right? So although and Will are not here today, they had W2 stuff come up. Obviously, I have a lot more flexibility because I'm a realtor out here, so that's why you guys see me so much. So whether you're tired of me or not, I'm sorry. I'm gonna be here a lot. Get used to it. Does anyone want to introduce themselves? Maybe it's your first call. Maybe you haven't done it in a while. Maybe you just want to say what's up, say a win, say have a question. Feel free to jump in right now. And yeah, feel free to introduce yourself.
Hi, everybody. My name's CL, and I'm originally from Whistler, British Columbia, and I'm moving around the States a lot. I've invested a little bit in small multifamily on my own, but I'm now getting into bigger things. So I thought it's time to start networking and getting to know people. So nice to meet you all.
Where are you at now?
I'm in just outside of Detroit in a place called Sylvan Lake. I didn't realize there were so many lakes here. They're everywhere.
I've been to Detroit one time because my friend did his residency there and went to med school out there. Yeah, we're not the brightest people. We went in the middle of December. Terrible idea, but whatever. We survived.
Yeah,
Story
it's
for
like
another
winter right
another
now.
show. Sorry, what was that?
I said it's kind of like winter. It almost feels like November today. It's raining and cloudy, but it's nice
Yeah,
because I'm by the lake.
I don't do well with the cold at all. So I wasn't a fan of that. But story for another time. I don't think MFC would like me if I talked about all my vations and wild stories and trips. Um, but very nice to meet you. Thank you for introducing yourself. Do you have a specific market you're looking in?
I think I'm going to be focusing in the Houston area
Okay.
and maybe in the Carolinas, but I'm not sure yet.
What about the Houston area do you like or are very interested in?
I'm still doing my research, but I have a realtor out there, and I don't know. I found it really hard to nail down my areas actually. And finally, I was just like, you know what? Just pick something.
So so I was mentioning this yesterday, and I don't mean it to make it sound so like it falls into your lap or like life works like this. It's not this intense, but it really is like, where do you find people that you want to work with and then pick a market together? Or if they're close to that market, you go from there. Like I was never against Florida. I was like, I like Florida, but it's just like, oh, I know a lot of people in Florida all of a sudden. And my broker's there and he's amazing. So I like working with him. And then we have all these deals coming in and I'm getting the most activity there. So I'm like, all right, like let's be realistic. It just makes sense to kind of like put the flag in the ground and say, all right, this is where we're going. And like you said, you have a realtor. That's a good start, but there's a lot more resources you're gonna want to build as that goes on and use them as leverage too. Like, hey, do you know anyone in XYZ? They live there, so it's a little easier. Obviously, I live in Los Angeles. No one likes investing here, and I'm starting to hate it at this point. So I'm gonna be going out of state more often. But yeah, that's my biggest thing with that is just always make sure you're all right. As much as I love Vegas, I wish Mario. I don't know if Mario's on here, but the running joke is I'm waiting for us to close the deal so I can go to Vegas for no reason, for a business expense. But as much as I love Vegas, I'm not gonna be like, oh, if I don't know a full team there, it's gonna be a little tricky. But let's say I don't know, Dallas, I don't know many people. Okay, so I'm maybe not be as active in Dallas, but in Florida, I'm definitely going to be.
Thank you.
Yeah, but that's awesome. I like Houston. I've been there twice. Their food is good, very good. All right, Mr. Jerry, how are you?
Hey, good man. How you doing?
Good, good.
Good. It seems like every time I log on a call, you're leading the call.
Well, the other two guys had W-2 stuff come up, which I don't have to deal with. So for me, it's just like, don't worry, guys, I got this. And I get it. I'm like W-2, you can't really control it. So I'm not.
Yeah.
I got it. I'm okay.
Yeah. Yeah. I'm Jerry Miles. For those of you who don't know me, I'm actually part of the leadership team with MFC, and we have our call tomorrow night. We talk about the current debt market and help you with funding your deals and things. So I'll put my info in the chat, but it's good to see everybody here.
Always good having you around, Jerry. Thank you. Guys, as the landscape changes a lot, and even going back to the point I was making earlier, where like if a new deal or an old deal you'd already underwritten or like you've maybe put an offer on and didn't work out, don't just assume, even if all the numbers on the property stayed exactly the same, you always want to make sure you have the up-to-date, like what's going on with the debt market, what's my money going to cost me, because that's the biggest probably the biggest expense you're going to have with all of this. And it's the thing that can evolve and change so quickly that you want to make sure you're on top of it with people that are definitely know the game, you can trust, and Jerry's the best person to talk to about all that. So definitely stop by tomorrow. Definitely put his info down. It's in the chat. Make sure you reach out with any questions, and let us know how else we can help you. That's what we're here for, you know. And one good part about MFC is I may not know the answer to everything, but there is definitely someone in the group that does. Which is why I love it when Jerry gets on these calls as well, because there's a lot of stuff I don't know. I'm like, Jerry, all right, cool, comes in for the save. But yeah, we have a lot of awesome people out here. So connect, save the number, shoot a text, introduce yourselves, and Jerry's a great person to connect with. My man, go for it, Mr. Jones. Oh, we can't hear you. Was that just me? I know you're not on mute on Zoom, but we can't hear your voice.
Can you hear me now?
Yeah. There you go.
Okay, yeah, it was in my headsets.
All right, cool.
How you guys doing? My name is Dana Jones. Also, I'm a lender in a multifamily space. So I've been doing like a couple multifamily deals. I've been doing it for like a while, pretty much. So my partner, she handles the residential. I handle the multifamily space, and also I'm an investor too. So I'm actually formulating a team in Ohio area and also the Dallas area. So what you were saying, it is always kind of good to have boots on the ground in those particular areas, because I live in LA as well. So I live in LA, but I kind of invest over the East Coast. So when you have boots on the ground, it's kind of good. And then being as though I'm a lender, I can actually analyze the deal, through thorough underwriting. So I can actually help out on the funding, and I can also, invest in it as well. But that's kind of like my background. And I've been in the real estate investing realm, I would say, for like 20 years.
Awesome. What cities again? I don't know. I can't recall if you had specific cities in Ohio you're looking at. Do you have a buy box?
Yeah. I would say Cleveland, Ohio, and like Dallas, Fort Worth, Texas.
Okay.
Yeah, so that's where I have my boots on the ground. So pretty much it's always good to have like a wholesaler, somebody over there, whereas though, they can kind of, get these off-market deals and things of that nature. So you can actually get able to get NOI, because we know that the rates are kind of going up and the cap rates and everything is kind of crazy. So, you gotta, underwrite the deal pretty good.
Definitely. I have something in Toledo. I don't remember if I've told you. We'll connect after though about that one.
Hey, okay.
For sure. Anyone else want to jump up? Okay, cool. So we do have kind of 3 different buckets that most of the people in the community fall into. You guys can see this. One of them is you come on calls, you listen in, you hear us out, you come on Sunday call, and maybe you're like, hey, multifamily is not for me. It's not for everyone. Totally understandable. It's really easy in this industry to get the shiny object. Yeah, that thing. Where it's like just dragged around a bunch of different areas. For anyone that's in sub 2, I'm in it as well with pace. It's great, but you can very, very, very easily find like a million different things to watch videos on and get pulled into a million different corners, to be fair. So it never hurts to learn. It never hurts to be involved in network. You never know. I think that's one of the biggest things I'm learning as I do this more often is you never know who the person you're gonna meet that's gonna lead to somebody that's gonna lead to a deal. Like the most random place, random Zoom you're on, or random networking event you go to, something could fall into place and you meet someone and it all works out. Life works in interesting ways, so let's keep put yourself out there. That's why I like giving you guys a chance to introduce yourselves as well, and find an opportunity to work together too. There is the passive investor and then the active operator. You guys can you see the distinctions here on the screen, but it's like, okay, how far along the journey are you? Are you just starting out? Are you like, hey, I'm very interested, I want to do XYZ? Or is it like, hey, I'm ready to step up and invest some money into this? Maybe you've done a deal or been a GP on a deal and gotten a little part of the equity, and really just for you to take that step up. And then we have different things to offer that will help with that with preferred partners. You guys will see a lot of them. I put our YouTube link earlier in the chat. I'll reshare it so you guys can get it again. a lot of them, the preferred partners have been on the Sunday activation Zooms. You'll see all of our old Zooms on here from all the different calls. So I think it's a great way to just catch up and see anything that you might have missed, or refresh your memory if you were on that call. So I'll play this. Hopefully you guys can hear it. Maybe.
Multifamily Freedom Chasers family, I have exciting news for you all. We are launching our Preferred Partners program for the community. You as a community member, as a Freedom Chaser, have access to this right now for free. So what is the Preferred Partners program? It is a program designed when you are ready to accelerate your multifamily real estate journey. You are ready to invest in yourself, to level up your education and business building experience. This is the place to go. These are the partners and resources that we have invested into and we use hands-on that have helped us level up in our multifamily journey. So pretty cool. Our preferred partners that are part of this list, it continues to grow, but right now they have over $2 billion of assets under management. Super cool. High-level teams and high-level operating individuals. So let me walk you through this here really quickly. We have Gabe Bowling's real estate training, Mastering Multifamily with Vina Jetty with her educational vault, Rockstar Capital and Robert Martinez. They have several different educational options. If you need mindset and performance coaching, we got Keston Glasgow with Purpose Ways, the Mirror Machine, website, funnels, marketing, everything you need there. Self-directed retirement services with Horizon Trust, CRM, an underwriting multifamily course with Ken Gee himself. And then if you don't have the funding, but you're ready to accelerate your multifamily journey and invest in yourself and invest in your business, we have DEC Global Enterprises where you can get no interest funding to fund those type of investments. So take advantage of the Preferred Partners program of the Multifamily Freedom Chasers, and let's continue our chase for freedom together.
That summarized it a lot better than I could. And this is our schedule. As we mentioned, we are always adding stuff and a lot of things going on. Monday nights, we'll start with Sundays. We have the activation Zoom with the guys, Marcel, Trevor, and Victor. Monday night, you get me again. Tuesday nights, you also get me, but Peter and I do the broker talks on Monday, although Will and I do these calls on Tuesdays. And then Wednesdays, we have the alternating between financing and foundations. As Jerry mentioned, he'll be on tomorrow, so make sure to check that out. Also note the time change on the Wednesdays. One is at 8, one is at 8:30. That will be our job every week to remind you guys which is which. And if I forget, I'm sorry. I'm just gonna warn you guys. All right, so this is just our contact information. Easy way to get a hold of me, Will, or Aldo. So feel free to reach out anytime. You guys can text me as well. That's why I put my number there, so don't hesitate to do that. Then today's topic about cap rates. So this is an interesting one. There's a lot of things that can go into cap rates, and funny enough, you are going to get a lot of opinions on kind of what the cap rate is and what it looks like. So before I start, because there's a lot of different directions I can go, is there any specific questions or obstacles or anything regarding just cap rate in general that you guys may have a question on? Is that a question for us? I can't hear what's going on. Either that was really good timing or okay. All good. All right, so cap rate. Big thing with cap rates, and one thing that's really important to understand is one, it depends on the market. Like you want to make sure, and I kind of hit this topic a lot, and I say this a lot, is when it comes to the cap rate, you want to make sure that you know what it is in a city, in an area, in a pocket, and make sure that you're either asking a few people, or I think the most important person to usually ask is going to be the person who's doing the debt. Brokers will give you their different opinions. One will say 5, one will say 5.5, one will say 5.25. With the cap rate, and what I say by that is, cap rate is, there's a few ways to go about it, but one main thing with the cap rate is you're trying to find out what the market cap rate is. Like, what does stuff usually trade for in an area? It's just another metric for comping different size buildings, is the easiest way to put it. It's kind of like the price per square foot in single family, which I'm not a fan of either, but that's a different story. I don't think that's a way you can comp or quantify a price, because there are a lot of components. Obviously, condition, vacancy, expenses, additional income, opportunity for XYZ. And what the cap rate does is you need the cap rate with the NOI to get your total price. That's essentially what it is. Very simple, nothing crazy. And NOI is net operating income, which actually I think it's easier if I just show you guys here. I'm going to share the screen and get back again on the Napkin underwriting. And essentially what it is, the cap rate's always going to be a factor. To me, it's always important to make sure that you are not necessarily overpaying excessively, but getting something that the terms in the deal itself make sense. One thing I do rely on when it comes to cap rate that's very important, and this is where you definitely have to put in a safety net, because it's one component of the equation that we have no control over, is what the market's going to look like in 5 to 7 years. Is, if for anyone that's familiar with Michael Blank's calculator, the STA, or the underwriting sheet, you notice on the variable tab that they have a cap rate interest bump. Now, why you want to put that in and why you want to make sure that you are fairly realistic with that is, if the cap rate increases, you have to add more NOI in order to sell your property for more. So if you're projecting, hey, I'm going to turn around, sell, buy it for 15, sell for 20 in 5 years, but the cap rate shifts, now you're going to have to do more to get that $20 million price point. You want to buy at a high cap rate, sell at a low. Obviously, justifying with the building and whatnot. So you'll see, for anyone on the underwriting tool, you guys can see that, right? Yeah. You'll see cap rate at purchase, exit cap rate based on purchase price. It's important to understand how, like, the correlation and the relationship between those work. With this sheet, the cap rate at purchase is very self-explanatory, and the exit cap rate, and why, if you notice here, it's in blue and doesn't have a formula, is that's where you got to know your market. You add the bump, you add some difference in there to make sure that you're factoring in for any market change, and understanding, like, what is really achievable, not only for the market, not only for the city, but for the class of the building. If you say, like, 2 buildings in the same city, different class, are not going to have the same cap rate. That's just natural how it works. Because at the end of the day, a luxury building is going to be a lot, you're going to get a lot less margins because it's a little bit safer than a value add property, like vacant units or demoed units, for example. So that's why we also have the class on here as well, and why that's so important in the whole scheme of things is, and I'm going to keep harping on this, know your area, know where you're looking to invest. And you guys will hear me say it all the time, and I'll say it again and again, but it's really easy to just changing a number or changing something in an equation because of false information given to you by someone else, per se, can really mess with your whole underwriting. And that's not a fun, experience I want anyone to go through. Okay, I tried doing something and my computer wasn't cooperating. No big deal. Why the cap rate on the exit is important is for 2 reasons. First being, if you're gonna sell, the cap rate is gonna be a large component of what that total valuation is gonna be at as well. So if you were planning to, let's say, sell using the 15 to 20 example, you got to make sure that you have the ability to actually sell for that amount if that's what you're underwriting and telling your investors, because their return is based off of that. It's factored into the sale because they own more than GPs do. So they are going to get more of that equity difference. So keep that in mind as well. That's why the cap rate, like knowing that is so important on that aspect of the analysis. It's really important to make sure that you're not over promising, especially to investors that you're hoping to do work with again. The last thing you want is to under deliver because of just like a minor mix up on regards to cap rate change, market change, things that we don't have control over necessarily. So just keep that in mind as well in regards to when you're underwriting. And on the napkin, when you are doing it, you kind of get into detail, but what I like to mention with the Michael Blank, the SCA calculator, it is a big component, and you'll get a better breakdown of how that looks and how future sales price factors into total returns. Even changing a couple percentage points is going to drastically alter the returns in the equation, depending on what price point you're at, of course, and what the NOI is. So on the, okay. So on the napkin underwriting sheet, you see here, this is, if you guys ever have a question, I'm gonna just touch base on this real quick with this sheet. If you ever have a question, if you see what I did here with the cap rate at purchase slide, double click it, look at the formula, it'll highlight the two things so you don't have to go scrambling looking for it. And it really explains like, okay, where are these numbers coming from? And then if you have a question on where those came from, click on that one. And then if you don't know what that is, come back and ask us. We try to make this very simple, and that's the point of the napkin, is making it very simple, user-friendly, and very easy to navigate, all right? So this one is NOI divided by the valuation, which the valuation here, I believe, is the price. Yes. The offer. You change the offer, it gives you the valuation, you put in the NOI based on the formula that it calculates there, and this pops out. So everything in blue will be what you fill in. Everything else will kind of self-populate, and again, we try to make it easy to navigate with. But you can see if I change the cap rate, for example, this exit cap rate is blue, so you're putting it in yourself. But if you change this even half a point, is it gonna let me? The upside change. So just to show you guys. From 259 to 71. It's a big difference. It's a massive difference. And that's just half a point, right? 0.5%, I should say. Any questions on cap rate in general? Okay. With the cap rate as well, I personally was never very big on, okay, what cap rate am I getting it at today? My concern always and usually is regarding the price of the property is what are the terms? And this is where a lot of the debt stuff and the terms you're acquiring with, because we are seeing seller carry become a lot more popular, a lot more sellers being a lot more open to it. And also with that, with the market being what it is, a lot of sellers are always going to ask, where am I going to go with that money? You don't want to get taxed on it heavily. So seller financing and different creative strategies like that would definitely help with mitigating that. So always be aware that the cap rate, although it does have an impact on what today's interest rates are, assumable debt and all these different ways of creatively buying, make it seem a little less intimidating if the cap rate's not where you want it to be. If I'm in an area where the cap rate should be, let's say 6, but I'm getting it at 5, but I have all these different terms lined up that really work in my favor and it's great debt or it's a low interest rate. All these different things factoring in allows me to be a little more flexible with that. Because that's going to be a direct reflection on the price that I offer or price that we end up getting under contract for. By the way, I forgot to mention this earlier. If anyone has any deals or anything that they want to underwrite or whatnot, please let me know. Or just put it in the chat and we can plug it in here as well. Jerry, real quick, just for some insight on, like, real quick from your end, what from the debt side, how much do you guys look at the cap rate in a specific area?
You know, I mean, really what someone's paying for the property doesn't really have a lot of bearing on what we can lend. I mean, we if we're looking Freddie and Fannie debt, I mean, we're kind of capped at 75% on Freddie, 80, sometimes 80% on Fannie. You know, but we're looking DSCR. You know, we need the DSCR, you know, in the 1.3 range on most deals right now. So if we can get to that 75% down, and if it works to that, you know, where you're getting it at a 6 cap or a 7 cap, it's kind of irrelevant. So,
Okay.
I mean, that's more of what your investors need to be concerned with. So, I mean, somebody can buy something at a 3 cap, but if they have the cash and they put the cash down, I mean, that's just more skin in the game. You know, you know, I've seen people trying to buy properties and putting 60% down and financing 40, you know, as the interest rates first started to turn. We didn't see them get closed that way, but it wasn't because the lender didn't close it. It was because they had other things going on. So
Definitely. So it kind of goes back to it as well. It's like, it's all, and another thing, keep in mind, don't try to justify a cap rate by just raising more capital or putting more cash into the deal. Because at the end of the day, yeah, the terms and how you acquire and what the bottom line and what those numbers look like are really important. But you want to make sure you don't over leverage yourself, or in this case, spread yourself too thin with, like, on the capital side, where the investors are going to look and like, hey, we aren't there now. You know, all of a sudden the deal doesn't look as sweet, or you're trying to raise too much capital in a small period of time. Sometimes better to buy maybe multiple deals and putting all your eggs in one basket as well. But I think now too, we are seeing it happen more, where you may have to raise more money or bring more down than initially or people would plan for. I think those days of 20% down on anything, whether single family or multi, are kind of going away pretty quick.
yeah, and Edward, just,
Yeah.
you know, to kind of put in perspective, I mean, I would be careful, you know, the more capital you have to raise, you know, the worse your cash on cash is going to be, you know, so be aware as you're raising, and just know that, you know, if your cash on cash is down around that 5% range, I mean, I think the 5-year treasury today was like at 4.95. So they're almost getting 5% on a US treasury. So to do cash on cash 5% on a multifamily deal, you know, is pretty risky when you can get that same return on a US treasury. So don't, I mean, I see a lot of people, like, you know, kind of overpaying from what I think, you know, on deals, because the market had been so high for so long. So I just, you know, I tell people, and it's probably to my fault, because I've probably talked to people out of deals that I didn't think were good, but just be careful. You don't want to see people get hurt. I mean, some people that are investing 100 grand in your deal, I mean, that might be their only 100 grand, you know, so I mean, treat it like it's grandma's money.
So cash on cash, and what should cash on cash, what should you look for? Cash on cash essentially is what your return on the dollar investment is a simple way to put it. What you should look for, a lot of that does determine a bit like risk space as well. you do also want to look at the average. Like if you're year one off the bat, you're like flawless, like okay, make sure you did your underwriting right, because year one you're gonna have the most growth on a value add. Jerry, would you say like right now, like people are looking at 7, 8, that's kind of the goal?
Yeah, I mean, that's ideal. I mean, and I see a lot of people, underwriting and seeing, cash on cash, 4% the first year, and then they're expecting 8, 9% the years after, and then just, keep in mind that, rents aren't jumping the way they were 2 years ago. That to think that, the rents are 1,100 in this place, and in 2 years time, you can get them to 13 or 14. I mean, that might be the case, but we're not in the same market we were 2 years ago. So
Yeah, and that's a big if that you don't want to rely on when you are underwriting. The more of the whole process you can have control over, the better it is in the long run, and you'll be a lot safer with the investors' capital. I think that's a big part too. And then everything on that is just a cherry on top, which is never a bad thing. No one's ever going to be mad at that. What requirements do lenders need to underwrite a deal? They're already talking about from like a document standpoint, or from a like sponsor or chief principal standpoint. Oh, KP.
for a KP, I mean, you're looking, you need a KP that has some experience with multifamily. If it's a bigger multifamily deal, especially, the general rule is net worth equal to or greater than the loan amount is the general rule for a KP. You hear all the gurus talk about credit score and things that, oh, well, you don't need a credit score when you get the balance sheet, this and that. But, they're not going to write a KP a loan that is lower than 660 in a credit score. And I've seen that, guy's worth 10 million and he's got a 580, 600 credit score, and it kills a deal, but it's, having all those ducks in a row. But the main thing that they're going to look at first of all is having the net worth equal to or greater than a loan amount. And just, when we're looking at like Freddie and Fannie debt, that could be a group of people. So if you have 3 people that are part of the GP team, you can underwrite them together. And if they have the net worth together, you can get to that point as well. So
that was even be my next question. Do you see more groups involved nowadays than in the single individuals?
There's a lot of groups, but generally it's just one person doing the KP, generally. I mean, it can happen with a group, but generally speaking, there's one guy or one girl that can take care of it. So
You said you want to buy at a high cap rate higher and sell it for lower. What do you have to do to reach that goal? A large part is the value add component of it. Like I was saying, well, a lot of times is a value add thing, but if it's a higher cap rate, usually there's like a higher risk at some point involved. Lower cap rate, for example, if you change it, it's gonna increase the price. So when I say that, it is make sure that, is that always going to be the case? Not necessarily, but also what's your spread? Like what's the potential NOI? What are the gaps in the potential? It gets tricky because it is so building dependent. Like for example, there's one in I was looking at in Georgia where it was 60% occupancy. No matter what cap rate I'm looking to buy that, it's just not gonna fit in the same formula as something with like a 10% vacancy. And like half these units were demo, like it was just a mess. I'm not saying that shied me away from the deal, but if you're asking me on that property specifically, how the cap rate's a factor, it's really hard to say. But the best way in order to control your cap rate is to bring it up to stabilize as much as possible. What that means is like you're as close to market rents, you don't have high concessions, loss to lease, bad debt. You just operate the property properly to where if you were to try to sell it, maybe there's not a bunch of value added left for the next person, or maybe there's just minor things here and there for the next buying party. But some people like that. Like what we consider a good deal, and a lot of investors in these communities consider a good deal with, I need to be able to do value add, I need to bring XYZ returns, I'm going to raise this capital. Not everyone plays a game like that. And that's something to keep in mind. You are trying to cater to as many people and try to increase the value and build this up to the best product you can, as if you're going to keep it yourself. Which my goal is to keep everything we get under contract and purchase. That would always be my plan. Just because I don't like selling anything personally. Now, is that always the case? No, not at all. But you try to do as much as you can. Yeah, increasing NOI is a great way, and just stabilizing, which is kind of two in the same. So I think again it goes back to when you are looking to, let's say, refinance, or this is why I think going on Jerry's call, asking questions and connecting and learning about the debt game, it doesn't only help you when you're looking to buy it yourself, but what you need to prepare for when you're trying to sell it on the back end, because you're dealing with the same stuff. People are still acquiring loans to purchase the property from you. And if that's not the case, then you're refinancing, and you definitely want to know what goes into that, because that determines what money you're pulling out of the deal and where the money is going to go, and returning your investors' money, which is a huge part of the equation. So keep that in mind as well, where you want to know the debt side of things, not only for today, but keep up with it even once you get a property under contract. Because that's going to affect your returns and your investors' returns based on what that market is looking like. And I'm sure Jerry can say it can change very quickly, and for better or worse. We don't know. It's one of the most unpredictable things, which is, it's, as a realtor, it's the funniest thing. What do you think is going to happen to rates? What direction is the market going? First of all, if I knew, I'd be a billionaire. Like, call what it is. Secondly, I can give you my opinion, and that's about it. So obviously there's some people's opinion we trust more than others, but it's important to make sure that it's very evolving and anything can happen at any time. I think it was Gabe Bowling, he says this a lot. He's like, when you realize how many players or how much the 1% plays around with in this space, you realize we're not fighting for the big fish. Like, there's so many higher level of companies and entities and capital being played that control this market that we don't have control over. So just be aware of that anytime you're looking to underwrite a deal, purchase a property. There's things out of our control, and you make that clear to your investor. The bottom line, like, sure, are they risking their capital? Yeah. Are you trying to make it feel as safe as possible? Absolutely. But at the end of the day, shit happens. Like, I don't know how else to put it. It's really hard to predict. As you guys saw here, just changing the percentage a little bit, drastic changes this entire price and equation, and all of a sudden your deal may not be as good. And you guys will see that more if you play with the SDA. I use it, so I'm familiar with how that one works. When you play with the sales price, you drastically change the returns. So it's really important to make sure that you guys are aware of that and keeping your eye out on that as well. And remember, the cap rates are evolving as well. As much as, like, when interest rates and change, whether it's going up or down and your debt's changing, your cap rate is going to be affected by that too. Because people your cap rate is essentially what it's going to look like when you're comparing a property down the street and you're like, oh, they bought at this cap rate. You hear a lot of people, a lot of brokers advertise like, this is what you're getting it at, your future potential cap rate is this. Also keep in mind that don't put too much weight on what that future cap rate or even cash on cash that a broker may be saying and pitching, because I'm a firm believer of, I'm not paying for the value of the work that I have to put in to raise it or stabilize that property. So again, sale tactics, you're always trying to get the most you can for your seller, which is understandable, but keep that in mind too with cap rates, and you'll see it a lot like on LoopNet and Crexy, so it's good just to have an idea of what that means and what it looks like. So this is just a deal that we've underwritten in the past. I don't know if this is half filled out or not. But has anyone been playing around with this underwriting tool and has any questions? And does everyone here have it? So yay, no, okay. I don't want to start a full underwrite just because we don't have too much time. Daryl, how have you been? Have you been underwriting a lot of stuff? I don't know if you're in a place you can talk, but oh yeah. Someone raise their hand. Go for it.
Hi there.
Hello.
My name is Fran. I'm in the Dallas area. I joined this call because I understand a little bit about cap rates and I don't get them. So what you added for me is that it depends on a lot of things what sets cap rate. So I understand a cap rate needs to be less than the coverage of your interest. So that way we can pay our debt. I also understand that if you're buying a brand new, let's say an A property or a C property, you're going to have a lower cap rate on an A, higher cap rate on a C. And from what you said, now I understand why, because a C is going to be having all the remodeling done on it.
Yeah, there's always
But
gonna be that value add component to that. Yeah.
So, but there's something there that I don't really understand on how they set the cap rate.
So I'm happy you asked that question because there is no, this is the cap rate. And this is one of the points I say, I try to bring up a lot is if I ask 5 different brokers or 10 different brokers in a city, what's your average trading cap rate today, right now for multifamily? You might get 4 or 5 different numbers, maybe more. Because yeah, will they all hopefully be in the same ballpark? Sure. But it's like, realistically, if I ask 10 different lenders today, if I had to just say what's the interest rate you can quote me on a traditional standard deal, maybe I don't want to use the multifamily space. Let's talk in the single family space, which is much more simple. If I go to a lender and I go to 10 of them and I say I'm putting 20% down, this is the purchase price, this is my credit score, what's the interest rate, you're probably gonna get 3 to 4 different answers. It's just the nature of how real estate works, where it's not how is it determined, because they're in a marketplace, there isn't one determining factor that's like, this is the rule of thumb and we follow it thick and through. Like, it's not something I can look up online, you know. It's actually one of the most annoying things to try to find online in an area is what is a cap rate in a specific city or neighborhood. Kind of a little frustrating. One way you can do that though is by looking at previous sales and finding out the comps. But here's a big but in that situation. If you don't know what how that building is currently performing, the sales price doesn't paint the whole picture. Like if I tell you a property is 60 units and the comps in the area are for 9 million and I get it for 5, did I get a great deal? Possibly. But if there's, like I used the example earlier, 40% vacancy, half the units are demoed, roof has issues, XYZ problem, seller needs to get out, they over leverage, all these back end stuff that factor into the equation, that affects the price, right? But if you just take what's the average cap rate and you factor that in, like that outlier into the equation, all of a sudden that's gonna throw off your entire number, right? So that's why it's really important to not worry too much about. It's important to know what cap rate is and how it plays a factor in all this. but don't use one rule of thumb across the board. I think that's a massive.
Okay.
Don't get caught
Okay.
up in that. Where it is good to know though, and knowing like what's the ballpark in a neighborhood or a city, for example, that you're looking to invest in, is for that future outlook. If I'm giving a bump, I need to know what my base starting point is. And I may be a little safer on that too. Like if I have 5 realtors, they tell me average is 5.5, I may start at 5.6 or 5.65. And then add a 0.1% every year, just to give myself a little bit of that cushion in case something happens. Now, you're hoping to be performing better and stuff like that, obviously, between now and 5 years, which is gonna happen, but you just don't know where the market's gonna be, and that's the biggest unknown. If interest rates skyrocket, different scenario. If they drop a lot like they did in 2020 and 2021, that completely changes that equation too. So cap rate is one thing that we talk about because it's important to know, and there's a lot of factors, but I don't like, as I'm underwriting or looking at things, like it's not something I'm thinking about a lot, to be fair. I think that's the best way to put it. So like when you're underwriting, for example, on here, and like I said, click these, like see what these formulas mean, see where they go and what they lead to and what they change. And I think that's really why we do this call, and why I like doing this call, is because I use Excel a lot. I'm familiar with this. If I see something on here and an error shows up somewhere, I can work backwards and find it, even if I didn't know real estate, right? And maybe not everyone has that or is familiar with Excel like that. So that's why I think it is also important when you tied into the actual real estate side of things. Like I can figure this out if I didn't know real estate. I just happen to grown up in real estate, so this is like I know this stuff too. But that's a good way to practice too, because I'll look at some calculators or sometimes someone will share one with me and like these errors are popping up or XYZ is not working. And it's really important to be able to backtrack and know kind of how to solve that problem. So definitely take that into consideration. And
Okay,
yeah, and if a
Thank
broker
you.
tells you, like, what cap rate do you buy at, I'm like, come on, like any number I give you, it doesn't mean anything. Like you can send me a good deal that hits that number and a bad deal that hits that number and a good deal that doesn't. I care more about like what's the opportunity. And here's another thing too that I think we should touch on real quick. If you are looking to work with people, if you are looking to build a team, if you are looking to work with anyone in this space, and whether you're new or just trying to scale up, it's really important to know what criteria people prefer. Do I prefer high value add? Do I have the capital to raise for high value add? Do I have the management and project management and resources and contractors available in XYZ city to put those pieces and take on a project like that? It's really easy early on to say, I want to do XYZ and 100 different things. But when you come to the offering table and things are getting serious and like your LOI is being pushed out there and you might be getting contracts accepted, you're now panicking to say, oh my God, where do I find the answers to all these? Exactly. So the question is, the reason you underwrite the exit cap rate at higher is to be conservative. Yes, 100%. Because you're projecting so far out into the future, to assume it's going to stay the same is a little risky. Could it happen? Yeah, of course. Anything could happen at this point. It's just a lot more risky to assume it's going to stay exactly the same. Good question.
So right now, interest rates are at about 7 now, right? They're coming out at 6, almost 7. Jerry?
I think on the multifamily level, there's a big it depends overshadowing all of that, because there's so many different components that can play into that. But I'll let Jerry jump in.
Yeah, I mean, the best that you're going to see right now is around the 6.5 mark. And that's through Freddie and Fannie. If you don't qualify for Freddie and Fannie for some reason, and you're looking at like a private lender, you're going to be, a 7.5 to 9.5. we've got a SBA deal right now, believe it or not. SBA loans, the 7A program, are at 11 and 12%.
Oh, wow.
So there's
So-
a big variance.
So something that you had said, and I don't really remember what it was, made me click saying, okay, I'm in the Dallas area. We're underwriting at about 5.5. So in my opinion, unless the numbers really pencil well, I better just sit back and watch until it starts working again.
When you say 5.5, is that interest rate?
No, cap rate.
So at least this is my opinion. If you're underwriting solely looking at the NOI and the cap rate, I think you're missing a lot of areas of opportunity because most of the time it's not going to pencil.
I can see where you're saying that. Yes.
Like you have to find like if everything remains the same, then yeah, that's not going to make sense. But if I see areas I could cut costs and not like cutting corners or being optimistic or sabotaging or like not sabotage, but like just trying to cut too much cost in the places that you can't.
Mhm.
Remember, especially like you're in Dallas, your taxes are a different monster. I'm looking a lot of
Yes.
Florida. Insurance is a completely different monster.
Terrible. Yes.
But again, one thing I like about those two areas with the two things we just mentioned is everyone's
Mhm.
fighting the same battle. Like it's not different for you or I, regardless of
Yeah.
what property we look at. That's one benefit of it. It's everyone's problem, right? It's not oh, I have an upper hand. You're not winning that, right? So with that, if you're underwriting solely on cap rate, it's important to see one, areas of opportunity, two, how does their additional income look? That's kind of like if I'm doing a quick run through, that's one of the first places I look. Like, are they bringing any income in? Where's that income coming from? And is there places that we can build that number up? Because it is one of
Yes.
the quickest ways, I would say, unless there's behind it. And then of course with expenses is there management there or is there person on site? What can my team bring to the table and provide on that set on a boots ground kind of approach?
Okay. Well, thank you both
Yeah.
very much.
Yeah,
Appreciate it.
and one more thing I want to make sure if this is a big component of it too. You can justify cap rate by putting too much down. That's not the way to justify cap rate though. For example, like if you're buying something and the cap rate's low, or it's like, or if you take a deal, let's say even Jerry's looking at something, and it's like to the point earlier, if you have to raise too much capital to justify a deal from working, you're putting your investors at risk.
I agree. Mhm.
Although it's nice not having a lot of debt because that's can be a different monster that a lot of people may be a battle that people have to face coming up. We don't know. But hey, if this game was easy, everyone would do it, right? I think that's the easiest way to summarize this whole thing. Like it's hard because, and not everyone does it because there's so many moving parts.
Yeah, and just remember that like right now is a time where kind of the weak or not savvy investors are going to get pushed out of the market. Because over the last 5 years or so, everybody that bought a deal made money on it.
Mhm.
You couldn't buy a deal and not make money over the last 5 years. And now we're not in that situation anymore. So a lot of these guys that have the good track records from the last 5 years, they're hurting right now because they've never seen this market. They've never been through this market. So just you use this time to make yourself better and say, hey, how can I make money in a bad market?
Mhm.
Or I wouldn't really call it a bad market. I would just say
A different market.
Yeah.
Mhm.
So learn how to make money in this market. And, in
Right.
the future, we'll have another market like we have the last 5 years and
Yeah.
put as much money away then as you can and don't get lazy. Because I think there's a
Yeah.
lot of syndicators and things that got lazy over the last 5 years. So.
Yeah, my running joke
Yeah.
for realtors was that anyone who got their license during COVID, and no offense to anyone here that did, but you guys will get what I'm saying, don't know how to decrease the price on a listing. They don't. They never had to. If you started during COVID, any realtor that put a listing up would sell over asking. You never had to use that button. And I'm sure there's a lot of realtors that don't know how to do it. Pretty-
I also think from what I've seen, a lot of people were in fear of missing out and they got together with people they don't know and they didn't really understand everything. And we all have to know what's going on before we jump in.
Yep.
Well,
And
thanks,
again,
guys.
this is one thing that we harp on a lot. That's why it's important to work and connect with people who have done something like some deals before. I think like if it's a bunch of people who are doing it for the first time, it just makes sure you have good guidance. Like the last thing you want to do is you don't know what you don't know. And I'm a firm believer in that. And I try to be careful too, where it's like if I don't know something, I don't know what to expect. I'm gonna
Mhm.
surround myself with people who at least have a little bit bigger outlook on it or have been through more of it to get an idea of what the obstacles could come up.
Yeah.
Awesome.
Thank you.
Thank you so much for the question. I loved it. I love the participation. Time went by fast again, which it seems to be like a
It did.
common
Yeah.
occurrence here. So Gary, thank you as always. You're the best. Everyone, please be on this call tomorrow. As you can see, there's a lot of value and a lot to talk about, a lot to learn. It's amazing. Please check out everyone else. Check out the different Zooms we have and we offer. We got Sunday calls Monday through Wednesday, and always trying to add more value and stuff. And I'll see you all next week. Take care.
Thanks, everyone.
Thank you very much.
All right, good night.
Bye-bye.